If you've read Atomic Habits by James Clear, then I'm sure you understand the importance of marginal gains. These are very small changes you make to your habits, to your lifestyle, to the way you live life, and over time these improvements become the building blocks of remarkable progress. Now, factor investing works a bit like atomic habits in the context where small adjustments to your index investing strategy can lead to significant long-term returns. To put significant in numbers, I'm talking about 5, 6, 8, maybe a 10% increase in annual returns as compared to the Nifty 50. And in this video, we shall understand how a plain, simple index fund can be made more powerful and profitable by applying different kinds of factors. Let's begin. Let's start with the most obvious question. What is a factor? So a factor is a specific characteristic or attribute that has been found to influence the performance and returns of a particular stock or portfolio. Not very convincing, Hannah? Well, think of it from a cricketing perspective then. So there was a time when the South African cricket team used to win matches purely on account of their fielding efforts. So if winning matches are the returns, then a large part of that winning was attributable to the fielding, which then becomes the factor. Similarly, the size of the company or market capitalization, as we commonly call it, is a very popular factor and forms the basis for the creation of the Nifty 50, the Sensex, the Nifty Midcap 150, the S&P 500 and other major indices. In fact, for a very long time, indices were generated based on the relative size of the companies. But as computing power improved, we saw and we are continually seeing the emergence of many more factors. I mean, look at this table here. So there are some simpler ones like profitability, sales growth, etc. But then there are some really unique factors like sentiment analysis, human capital, cybersecurity, and even social media influence. Now, generally a factor is not an isolated characteristic, and more often than not, these are positioned as a package of attributes. For example, and as a principle, the value factor focuses on identifying companies whose market price per share is lower than its intrinsic value per share. Now, there is no accounting metric called value, and therefore the value factor uses a multitude of variables like the P ratio, the PB ratio, price to sales, dividend yield, EV by EBITDA, the buyback history, etc. to arrive at a value score. So it's a sort of mix and match, and every analyst, every fund house would have a different model, a different methodology to define what is momentum, what is quality, and what is value. Of course, all this can be a bit complex for everyday investors like you and me, which is why these are not named factor funds, but instead they are called smart beta funds, which is definitely a more marketable name. But beyond a catchy category name, these funds come with many advantages, which includes a passive style of investing, a transparent rules-based methodology, a broadly diversified portfolio, and a lower expense ratio when compared to active funds. Now, India's tryst with smart beta funds is both small and very recent, with the cumulative AUMs a little over 6,000 crores. But with the global factor investing market now at an AUM of $1.3 trillion, I think it's only a matter of time when smart beta funds become the primary investment vehicle for millions of mutual fund investors in India. With that being said, let's examine the 4 most commonly used factors in greater detail. As I explained earlier, the value factor is based on the idea that companies with a lower valuation tend to generate higher returns. What is low valuation? Well, the classic way of defining a value company is to pick out the top 30% of stocks that have the highest book value to market cap ratio, while growth stocks are amongst the lowest 30%. So that's one way, and within the Indian universe, there are 2 different value factor based indices that one can consider. The first one is the S&P BSE Value Index, which uses a combination of book value, price, earnings and sales to arrive at a value score, which is then applied over the BSE Large Mid Cap Index to come up with a value-based index of 30 stocks. The second value-based factor fund is the Nifty 50 Value 20 Fund, which assigns weights and ranks companies on the basis of their return on capital employed, their P ratio, the price to book ratio and the dividend yield. Understandably, this methodology is looking for companies with a high ROCE, a low P ratio, a low PB ratio and a high dividend yield. Now, when I compare it with the Nifty 50 TRI, one notices that the Value 20 index has handsomely outperformed over these last 5 years, and it has done that at a lower level of volatility. In fact, over many years, the performance of the Value 20 index has been somewhat around the Nifty 50, except the years 2020 and 2021, when the value index made massive gains. The next factor, and something that's growing in popularity, is momentum. Now, on a conceptual level, a momentum factor is a bit odd, and that's because what this factor says is that the stocks that have performed well in the past as compared to their peers will continue to perform well in the future and vice versa. To put it differently, the winners keep winning and the losers keep losing. Of course, all this is very time bound, and momentum investing requires a constant moving in and moving out of stocks over a 3, 4, 6-month period in order to capture the upside. Now, within the Indian market, there are two types of momentum based factor funds: the Nifty 200 Momentum 30 and the Nifty Midcap 150 Momentum 50 fund. As expected, each of these indices have their own universe of stocks, methodology, selection, weighting, and normalization criteria. And over a 5-year period, this strategy has done slightly better than the market cap weighted Nifty 50 index. However, when we look at this data on an year-on-year basis, it seems to suggest that the momentum strategy works extremely well when the stock markets are rising, and it shows signs of weakness when the bear market sets in, as it did in the year 2018 and more recently in 2022. The next factor is quality, and unlike momentum and value, there's a lack of consensus on what exactly quality means. Now, generally, a quality company is one that is highly profitable, has a strong balance sheet, and has little or no debt on books. For instance, the S&P BSE Quality Index uses 3 distinct metrics to come up with a quality score. It looks at the company's return on equity, and higher the ROE, the better it is. The factor also uses the balance sheet accruals ratio, which is based on the company's net operating assets, and a low number is always better. And then there is the financial leverage ratio, which is calculated by dividing the book value from the company's total debt. Pleasantly, the Nifty offers a lot more index options around quality, and one can choose variations for the Midcap 150, the Nifty 100, and the Nifty 200. Now, for the sake of comparison, I have used the Nifty 200 Quality 30 index, and something we can distinctly notice is the wide variation in the Nifty 50 returns and that offered by the Quality 30 index. I mean, look at 2011, 2013, 14, 15, 2019, 2020, and again in 2022. And finally, we have the low volatility factor, and I have to go back to a statement we've heard so many times, that is, the more risk we take, the greater shall be the returns. While this might work in most cases, what's also true is that there are many studies that show a low risk portfolio outperforming a high risk one. It's an approach that gained popularity after the 2008 global financial crisis, as investors developed a preference for defensive, less volatile stocks. Now, volatility here is generally calculated as the standard deviation of a stock's daily price returns for the last 1 year or so. Again, there is a Nifty methodology and a slightly different S&P methodology, but true to its nature, the low vol index has kept the volatility lower than the Nifty 50, although it has not been able to match the returns. On an year-on-year basis, it's remarkable how close the returns are to the Nifty 50, which, if you look at it differently, means you can get almost Nifty 50-like returns, but at a lower level of volatility. Alright, so we've looked at the 4 most common factors, and the reason I did this year-on-year analysis of returns is to emphasize the fact that the performance position of a factor keeps changing in line with what's happening on the economic front. In fact, let me sort this table by ranks. Here we go. Now notice how just 2 factors, the momentum factor and the value factor, seems to have dominated the performance charts. Momentum did extremely well during the bull run of 2014, 15, 16 and 17, and again in 2019 and 2021 when the stock markets were on fire. On the other hand, the value index took charge when there were some slippages and corrections, which happened in 2018 when the market valuations were absolutely berserk, and in 2020 and 2022 on account of the pandemic and the Ukraine-Russia conflict. Now, of course, this is not easy as it sounds, because although this table here gives us a very visible pattern, it still requires us as investors to predict how the market is going to move over the next 1 year, which is no easy task. But some information can be used, right? For example, the price earning ratio can help us understand if the markets are expensive, super expensive, cheap or neutral. We can study liquidity, we can study volumes. We can listen to what experts have to say, the hypothesis they are extending, so on and so forth. But let's come back to the table and map out a fifth element, which is our Sasta Sundar Nifty 50 index. Alright, so barring a couple of years, the Nifty 50 TRI has been a poor performer when stacked against our 4 factor indices. I mean, it's either rank 4 or 5, and I hope now you can understand why I think factors will be a primary passive investing vehicle and why it's the future of index investing. In fact, let me map the performance numbers as well, and what's interesting to see here is a sizable difference between the rank 1 and the rank 2 factors. For instance, look at 2012, 2013, 14, 2018 and 2021. The gap is massive, and in most of these years, the number 1 rank has been the momentum factor. Another difference I'd like you to notice is the difference between the best performing factor and the Nifty 50. I hope I'm not sounding like a Nifty 50 basher, and it's not my intention, but what I want to give you here is a little more perspective, some more data, so that we can all put our monies to better use. So look at the difference here: 14%, 10%, 13, 17, 15, 26%, 29%. That's a lot of alpha, and although you, I or anyone will not get it right every single time, but with a little thought and a little experience, it is my belief that factor investing or smart beta funds will immensely improve our portfolio returns, and it definitely requires some allocation in our portfolios. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. Now the question comes, how can one invest in these factors? And there are 3 ways of going about it. The first is via mutual funds and exchange traded funds, or ETFs. So as of last week, there are 18 factor-based mutual fund schemes and 22 exchange-traded funds, and it's a number that has been increasing steadily over the last couple of years. The second way one can invest in a smart beta strategy is through investment platforms like Smallcase. So there are tons of factor-based strategies on that platform. There are a bunch of momentum strategies offered by Capital Mind, Right Research, Weekend Investing, Windmill Capital, etc. Then there are small cases on the quality factor, the value factor. There are multi-factor strategies, and there is also one small case that goes by the name multi-factor dynamic quantitative algo, which is quite a mouthful. And method number 3 to getting started on factor investing is the DIY or the do-it-yourself strategy. Now, this isn't everyone's cup of tea, and if you don't have the time or the inclination, then you are better off paying that 0.5% expense ratio to a mutual fund who will manage everything on your behalf. But if you want to try this yourself, then a good starting point is for you to understand the index creation methodology used by Nifty indices and S&P Global. This might look a little complicated in the beginning, but with some practice and a lot of automation, this exercise will turn into a delightful activity. And who knows, maybe you can list your factor-based model on Smallcase and have thousands of people to subscribe to it. In addition to these 3 methods of investing, I'd like to reiterate the fact that factors keep on rotating from time to time, and no single factor should be seen as a sure shot way of creating wealth. In that regards, I would encourage you to not look at SIPs as much, and one should explore using lump sum investments so that you can exploit the right factor at the right time. I know this is not what I generally say, and I've always asked you to do an SIP, but under the circumstance and from what we have learned in this video, do think about doing it the lump sum way. Alright, so at a basic level, factor-based investing is simply about defining and applying a set of rules. If you recall my Superman video, we had done something similar using the P ratio, which had given us a 2% improvement in SIP returns. This video here is my attempt to do something similar by using factors and to put a moral around this story. If the right factor is chosen at the right time, then in my opinion, you can make up to 10% higher returns as compared to what the Nifty 50 can offer. So that's a big incentive, but nevertheless, smart beta strategies and factor investing is going in only one direction, and I won't be surprised if a lot of our future wealth comes from these kinds of investment products. If you found value, again, no pun intended, but if you did find value in this presentation, then do press the like button, do share this video with your friends. Ask them to subscribe to my channel and I'll see you 3 days from now. Until then.